Their price controls have been in this country at various times, and that's followed up even the best of businesses. I mean, I wouldn't be able to raise the price on December 26th of See's Candy if we had price controls, and we've had them in this country. But that doesn't make it a lousy business if that happens to happen, because you're not going to have price controls forever. We had them in the early 70s. So the wonderful business, you can figure out what will happen. You can't figure out when it will happen. You don't want to focus too much on when. You want to focus on what. If you're right about what, you don't have to worry about when very much. Is there an area I'm missing back there any place? I just want to make sure I'm not focusing all of them on one place. Let me get this gentleman over here. The question is about my business mistakes. How much time do you have? Well, the interesting thing about the mistakes is that in investments, at least for me and for my partner Charlie Munger, the biggest mistakes have not been mistakes of commission, they've been mistakes of omission. They're where we knew enough about the business to do something, and for one reason or another, we sat there sucking our thumbs instead of doing something. And so we've passed up things where we could have made billions and billions of dollars from things we understood. Forget about things we don't understand. In fact, I could make billions out of Microsoft. Doesn't mean anything because I never understand Microsoft. But if I can make billions out of healthcare stocks, then I should make it, and I didn't. When the Clinton healthcare program was proposed and they all went in the tank, we should have made a ton of money out of that because I could understand it. I didn't make it. I should have made a ton of money out of Fannie Mae back in the mid-'80s because I understood it and I didn't do it. Those are billion-dollar mistakes or multi-billion-dollar mistakes that generally accepted accounting principles don't pick up. The mistakes you see, I made a mistake buying U.S. Air Preferred some years ago. I mean, I had a lot of money around. I make mistakes when I get cash. Charlie tells me to go to a bar instead. Don't hang around the office. But I hang around the office and I got money in my pocket. I do something dumb. And it happens every time. So I bought this thing. Nobody made me buy it. I now have a 800 number I call every time I think about buying stock in an airline, and they talk me down. They say, I say, well, I'm Warren, I'm an airaholic, and then the guy says, keep talking, don't hang up, and don't do anything rash. And finally, I get over it. But I bought it, and it looked like we were going to lose all our money in that, and we came very close to losing all our money, and you can say we deserved to lose all our money, and we bought it because it was an attractive security, but it was not in an attractive business. I did the same thing with Solomon. I bought an attractive security in a business that I wouldn't have bought the equity in. So you can say that that's one form of mistake, buying something because you like the terms when you don't like the business that well. And I've done that in the past and probably do it again. The bigger mistakes, though, are the ones of omission. I did back when I had the $10,000. I put $2,000 of it into a Sinclair service station, which I lost. So my opportunity cost on that's about $6 billion right now. I've fairly big mistake. Yeah, it makes me feel good when Berkshire goes down then because the cost of my Sinclair station goes down too. My 20% opportunity cost. But I will say this: you talk about learning from mistakes. I really believe it's better to learn from other people's mistakes as much as possible. But we don't spend any time looking back at Berkshire. I've got a partner, Charlie Munger. We've been pals for 40 years. We've never had an argument. We disagree on things a lot, but we don't have arguments about it, and we never look back. We just figure there's so much to look forward to that there's just no sense thinking about what we might have. It just doesn't make any difference. I mean, you can only live life forward, and you can learn something perhaps from the mistakes, but the big thing to do is stick with the businesses you understand. And so if there's a generic mistake of getting outside of your circle of competence and buying something because somebody tips you on it or something of the sort in an area you don't know anything about, I mean, that you should learn something from that, which is that you stay with what you can figure out yourself. I mean, you really want your decision making to be by looking in the mirror and saying to yourself, I'm buying 100 shares of General Motors at 55 because. And I mean, it's your responsibility if you're buying it, and there's got to be a reason. And if you can't state the reason, you shouldn't buy it. If it's because somebody told you about it at a cocktail party, not good enough. I mean, it's got to be something. It can't be because the volume, the chart looks good on it or anything like that. It's got to be a reason you'd buy the business, and we stick to pretty carefully. That's one of the things Ben Graham taught me. Yeah.
But the current tenuous economic situation in the world, although our economy seems to be still chugging along quite well, where are we going? What could
question about what's going to happen to interest rates or where we go in the world. I don't think about the macro stuff. I just important. What you really want to do in investments is figure out what's important and knowable. If it's unimportant or unknowable, you forget about it. What you talk about is important, but in my view, it's not knowable. Understanding Coca-Cola is knowable, or Wrigley, or Eastman Kodak, or anything. I mean, you can understand those businesses. That's knowable. And whether it turns out to be important depends on where your valuation leads you and the current price and all of that. But we have never either bought a business or not bought a business because of any macro feeling of any kind. We don't read things about predictions about interest rates or business or anything like that because it doesn't make any difference. I mean, let's say in 1972 when we bought See's Candy, I think maybe Nixon put on the price controls a little bit later. Let's say we'd seen that. But so what? We'd have missed a chance to buy something for $25 million that's earning $60 million pre-tax now. I mean, we don't want to pass up the chance to do something intelligent because of some prediction about something that we're no good at anyway. So we just don't read or listen to or do anything in relation to macro factors at all. Zero. And the typical investment counseling organization goes out and they bring out their economists, they trot him out, and he gives you this big macro picture, and then they start working from there on down. In our view, that's nonsense. And if Alan Greenspan was on one side of me and Bob Rubin on the other side, they were both whispering in my ear exactly what they're going to do the next 12 months. It wouldn't make any difference to me in what I pay for executive jet or general reinsurance or anything else I do. Yep. Well, what's the benefit of being an out-of-towner as opposed to being in Wall Street? I worked in Wall Street for a couple of years, and I like. I've got my best friends actually, and I'm on both coasts, and I like seeing them, and I get ideas when I go there. But the best way to think about investments is to be in a room with no one else and just think. And if that doesn't work, nothing else is going to work. And the disadvantage of being in any kind of a market type environment on Wall Street would be the extreme is that you get overstimulated. You think you have to do something every day. I mean, the Candler family paid $2,000 for this company, and you don't have to do much else if you pick one of those. And the trick then is not to do anything else, even not to sell it in 1919, which the family did later on. So what you're looking for is some way to get one good idea a year, and then ride it to its full potential. And that's very hard to do in an environment where people are shouting prices back and forth every 5 minutes and shoving reports under your nose and all that. Because Wall Street makes its money on activity. You make your money on inactivity. I mean, if everybody in this room trades their portfolio around every day with every other person, you're all going to end up broke, and the intermediary is going to end up with all the money. On the other hand, if you all own stock in a group of average businesses and just sit here for the next 50 years, you'll end up with a fair amount of money, and your broker will be broke. So his activity is he's like a doctor who gets paid on how often he gets you to change pills. I mean, basically. I mean, if he gives you one pill and it cures you the rest of your life, he's got one sale, one transaction, and that's it. But if he can convince you that changing pills every day is the way to great health, it'll be great for him and the prescriptionists, and you'll be out a lot of money, and you won't be any healthier. You'll be a lot worse off financially. So you want to stay away from any environment that stimulates activity, and Wall Street would have the effect of doing that. I used when I went out to Omaha, I'd go back about once every 6 months, and I'd go back with a whole list of things I wanted to check out one way or another, companies I wanted to see, and I would get my money's worth out of those trips. But then I'd go back to Omaha and think about it. Yeah.
How should an investor evaluate owning shares of Berkshire Hathaway or Microsoft when they don't pay dividends to the investor?
Yeah, well, the question with Berkshire Hathaway, the question was about evaluating Berkshire when it doesn't pay any dividends, and it won't pay any dividends either. It's a promise I can keep. All you get with Berkshire, you stick it in your safe deposit box, and then every year you go down and fondle it. You take it out and you fondle it, then you put it back. And I mean, there's enormous psychic reward in that. You don't underestimate it. But the real question is whether we can keep retaining dollar bills and turning them into more than a dollar at a decent rate. And that's what we try to do. And Charlie Munger and I have our money in it to do that. That's all we'll get paid for doing. We won't take any options. We won't take any salaries to speak of or anything. We'll ride around in the plane. But that's what we're trying to do. It gets harder all the time. The more money we manage, the harder it is to do that. And we would do way better percentage-wise with Berkshire if it was 1/100th the present size. But it is run for its owners, but it isn't run to give them dividends, because so far every dollar that we've earned and could have paid out, we've turned into more than $1. It's worth more than $1 to keep it, and therefore it'd be silly to pay it out. Even if everybody was tax-free that owned it, it would have been a mistake to pay dividends at Berkshire, because so far the dollar bills retained have turned into more than $1. But there's no guarantee that that happens in the future, and at some point the game runs out on that. But it is the goal of, I mean, that is what the business is about. We're not, nothing else about the business do we judge ourselves by. We don't judge it by the size of its home office building or, you know, anything of the number of people working around it. We've got 12 people at headquarters. We've got 45,000 employees at Berkshire and 12 people at headquarters, 3,500 square feet. And we won't change it. So we will judge ourselves by the performance of the company. And that's the only way we'll get paid. But believe me, it's a lot harder than it used to be. But anything way in the back, because I want to make sure I'm not missing people back there that haven't called me. Okay, then we'll go to the, well, how about way over there on the aisle? Yeah. I missed this. What made me decide to invest what?
One of your investments has reached its full potential. As you said earlier, that you...
I missed the last part of it. Reached its full potential. Well, ideally, you buy in businesses where you feel that will never happen. In terms of, I mean, I don't buy Coke with the idea that it's going to be out of gas in 10 years, you know, or 15 years. I mean, there could be something happen, but I would think the chances of that are almost nil. So what we really want to do is buy businesses that we would be happy to own forever. It's the same way I feel about people who buy Berkshire. I want people to buy Berkshire that plan to hold it forever. They may not for one reason or another, but I want them at the time they buy it to think they are buying a business that they're going to own forever. And I don't say that's the only way to buy things. It's just that that's the group I want to have join me, because I don't want to have a changing group all the time. I measure Berkshire by how little activity there is in it. If I had a church and I was the preacher and half the congregation left every Sunday, I wouldn't say, oh, this is marvelous because I have all this liquidity among my members, you know. There's terrific turnover, you know. I would rather get a church where all the seats are filled, you know, every Sunday by the same people. Well, that's the way we look at the businesses we buy. We want to buy something that we're really happy to own virtually forever, and we can't find a lot of those. And back when I started, I had way more ideas than money, so I was just constantly having to sell what I thought was the least attractive stock in order to buy something that I just discovered that looked even cheaper. But that's not our problem really now. And so we hope we're buying businesses that we're just as happy with 5 years from now as now. And if we ever found some huge acquisition, you know, then we'd have to sell something maybe to make that acquisition. But that would be a very pleasant problem to have. We never buy something with a price target in mind. I mean, we never buy something at 30 saying if it goes to 40, we'll sell it at 50 or 60 or 100. We just don't do it that way any more than when we buy a private business like See's Candy for $25 million. We don't say to ourselves, if we ever got an offer of $50 million for this business, we'd sell it. That's just not the way to look at a business. The way to look at a business is this going to keep producing more and more and more money over time? And if the answer to that is yes, you don't need to ask any more questions. There's a, yeah, way back there.
Just the same principle in mind. What was the motivation for taking a piece of Solomon and similarly long-term capital? And how did you come up with the valuation?
Well, Solomon, like I say, I went into that because it was a 9% security in 1987, September 1987. The Dow was up 35% that year. We'd sold a lot of stuff, and I had a lot of money around. It looked to me like we were never going to get a chance to do anything. So I took an attractive security form in a business I would never buy the common stock of. And I went in because of that, and I think that's generally a mistake. It worked out okay finally on that, but it's not what I should have been doing.
Here is a key point from Warren Buffett. Warren Buffett emphasizes the importance of focusing on the quality of the business rather than getting caught up in macroeconomic predictions. He believes that trying to predict market fluctuations or interest rates is futile, and instead, one should concentrate on understanding and investing in solid businesses. Buffett's investment philosophy is rooted in the idea of buying companies that possess a durable competitive advantage, meaning they have a strong, sustainable edge over their competitors, which can protect their market position over the long term. Buffett's approach to investing is also characterized by a preference for simplicity and understanding. He advises against investing in businesses that are too complex or difficult to understand. Instead, he focuses on companies with straightforward, easy-to-understand operations. This clarity allows him to make more accurate predictions about their future performance. For example, he prefers businesses like Coca-Cola, which have a simple product and a strong brand, making them easier to evaluate and more likely to provide consistent returns over time. Integrity is another cornerstone of Buffett's investment strategy. He values integrity not only in his own business dealings, but also in the management teams of the companies he invests in. Buffett believes that integrity, combined with intelligence and energy, is essential for long-term success. Without integrity, the other qualities can become dangerous liabilities. He advises young professionals to cultivate habits that reflect integrity and to avoid behaviors that are self-destructive or harmful to others. Buffett's perspective on mistakes is also noteworthy. He distinguishes between errors of commission, such as making a poor investment, and errors of omission, which involve missing opportunities that could have been highly profitable. He believes the latter are often the more costly mistakes. Buffett has missed out on significant gains by not investing in businesses he understood well and had the opportunity to buy. Learning from these mistakes, he emphasizes the importance of acting on sound opportunities when they arise. Lastly, Buffett stresses the significance of evaluating a business's long-term potential rather than focusing on short-term gains. He looks for companies that he can hold forever, which continually generate increasing profits. This long-term perspective aligns with his broader investment philosophy of buying high-quality businesses at reasonable prices and holding them indefinitely. This approach has allowed Buffett to build substantial wealth through Berkshire Hathaway, reflecting his belief in the power of patience and strategic, thoughtful investing.